Coming up today, a mixed start for markets. Are AI stocks a time bomb? Are we already in a recession? Iran about to attack. Oil rips higher. Gold hits record highs. The trade that can outperform in a recession. And I get you all prepped for another big week in financial markets. Let's have a good one, guys. And good evening, good morning, good afternoon, wherever you are joining me in the world today. Hope you're feeling good and ready for another big week in financial markets. We've got quite a lot going on this week. Kicking off tomorrow, PPI inflation data. Heading into Wednesday, biggest one of the week, CPI inflation data. We got to look at retail sales on Thursday and the consumer sentiment survey on Friday. And it's retail week. Not only are we going to get a look at retail sales data, we've got a number of big key retailers reporting earnings this week. Home Depot tomorrow. Thursday we'll get to hear from Walmart and a few Chinese ones as well. Alibaba, JD.com, and a few smaller American retailers throughout the week. We'll also get a look at hedge funds' latest movements Wednesday afternoon with their Form 13Fs due to be filed. They've always got 45 days after the end of the quarter to let us know what trades they made in the previous quarter. So most of them will file right at the end of that deadline. So I'll keep you guys updated this week on what some of the biggest hedge funds out there, like Bill Ackman from Pershing Square, what his moves have been in Q2, along with a number of other key hedge funds we'll take a look at later on this week. Another key event this week is we're waiting for Iran's response and supposedly a large-scale attack on Israel. It's already getting markets moving. To start off the week, I'll dive into this a bit later, and then we'll look at the commodity markets being affected by that as well. I'll also give you an interesting look at some year-to-date seasonality, and we'll also talk about the chances of a recession happening and what sort of trade could outperform if that does happen. First off, let me just give you a quick bird's eye view of the technical price action we're getting across key markets. To start the week, high highs, high lows in S&P 500 on a typical quiet, low-range day. Market does appear to be coiling up after it bounced off that really sharp gap down last Monday morning. You can see my wave flow indicator here starting to coil up. Market could be getting ready to turn over again, especially if we get a hot CPI print or things in the Middle East spill overboard as well. Breadth's not the best here. Looking at volume breadth, we still have more than half of all stocks above their 50-day average, but we're also getting more stocks hitting 52-week lows and 52-week highs. Still got a little backwardation in the volatility term structure. 9-day higher than the VIX 30-day. Option dealers pricing in a bit of volatility this week, probably with CPI data and Iran. Good news is we've still got volatility risk premium down near zero. Bond market volatility is elevated, as is oil and gold market volatility starting to break out as well. Start off the week, we've got bond yields stable, 2-year at 4%, 10-year at 390. We'll be looking for this 380 level to be defended. High yield bonds still holding up above their 50-day VWAP. The yen looks to have calmed down as well. We'll keep an eye on the Japanese yen this week. After the big scare to start off last week was based on the Japanese yen. There's a look at Bitcoin, $59,000 to start the week. Like I said, I'll come back to gold later, which hit a new all-time high today and a pretty good bounce in crude oil, now back above its 50-day VWAP. And just looking across sectors, it was mostly bearish out there today. Of course, gold miners doing the best. Little bounce there in energy stocks with crude and still a little bit of a defensive rotation. Got utilities still holding up well. But first, let's just look at some data, research, and headline that you guys enjoy learning about. The first is what happens when the VIX goes above 50. Like we saw this time last week. It shot up to 65. Well, this chart's a little blurry, but basically it's happened 92 times before, and believe it or not, 91 times the S&P 500 is higher a year later. But what you also see, like we quite often see in the volatility market, is clustering. Back in 2008, 2020, we can get multiple days, even stretching out over multiple weeks when the VIX is above 50. However, it does indicate maximum fear, and the difference about this time compared to last times is this was really more isolated. Fundamentals is not as bad, and it was kind of strange almost having that sharp VIX spike when the markets had just hit all-time highs. However, another good stat here from Fundstrat is when the S&P 500 is up more than 10% in the first half of the year, which we've got this year. Most of the time, the second half will finish positive as well, especially in the era of the Fed put, first introduced by Greenspan, 1987 after Black Monday, in which we got a lot of other changes in financial market around those mid-late 80s, electrification, amongst other things. You could kind of think of financial markets really being modernized in the mid-late 80s. Since then, the second half has always finished higher when we're up by more than 10% in the first half. And we are having a really good election year. We're up over 17% coming into July. Got a bit ahead of ourselves. Had a bit of a healthy pullback. We still could have more to go. Remember that low back in April in the S&P was just below 5,000. So if we got back to 5,000, that would take us back in line to where we normally are around this time of year in an election year. You can see that bit of softness from August through October. And normally we can find a bottom around here, rally into Christmas. And politically, this is a similar year to 1968, when Lyndon Johnson pulled out of the presidential election race, just like we saw Biden pull out on the 22nd of July. And ever since then, the odds, polls, popularity of Kamala Harris has shot right up, according to mainstream media. A lot of the Trump trade in small caps, Bitcoin and other areas has had a sharp pullback along with the market, but of course there's been other things attributed to that as well. Japanese yen unwind, maybe what's going on in the Middle East. However, as far as corporate earnings, that's actually coming better than expected. So the market's not pulling back on a worse than expected Q2 earnings season. There has to be other things going on. Looking at some more seasonality, we're tracking very similar to last year. Rallied up into late July, pulled back into late October. We could be following that similar path again. And there is something about August. Looking back in history, you can see these large external events with S&P 500 having some sharp intra-month drawdowns in this month of August. So we may not have seen the worst of it just yet. However, a lot of investors have been spooked out based on last week's events. We can see that in consolidated equity positioning. It's nearing highs a bit over a week ago. However, that's sharply pulled back into underweight already. A lot of investors did not buy the dip, and in fact they've bailed on this market. We also saw that in a sharp rise for the demand for stock market insurance, cost of hedging. S&P 500 puts shot up last week. See that in the put call ratios, and quite elevated implied volatility, especially for out of the money puts. And can you imagine if we don't go into a recession in the next 3, 6, 9 months, then the market awakens to that reality. And in that time, inflation has stayed low and the Fed's been able to pull back interest rates. What do you think's going to happen to that over $6 trillion in record money market funds? People just earning interest. When they see their interest come down every month, every quarter, lower interest repayments, and they don't see the stock market go down. Maybe it's going up. Maybe they can still find stocks yielding 4 or 5%. That could be a lot of dry powder ready to come back into the stock market. However, a big part of this bull market hinges on what got us here in the first place. We very well may have had a recession last year if it wasn't for the AI boom and the huge amount of spending by cash flush tech companies on AI infrastructure. And for sure there's risks. Depreciation, one of them. Companies that have spent huge on AI infrastructure, GPU chips, data centers, they've got to prove to investors that's going to result in some profits in the quarters and year or two ahead. Investors want to see a return on their investment. We don't want to see these assets being depreciated with their mark-to-market value going down more than the profits they are generating. Because these GPUs don't last forever. There's new ones coming out all the time. And so this is something the market's still skeptical about. It's good news for Nvidia, the picks and shovels supplier of this AI boom. But for all the companies buying all that, they need to show some profits pretty soon. Otherwise, the market might get upset with that. And we'll get to hear from Nvidia a bit later on this month, as they'll be reporting earnings on the 28th. And they should easily meet analyst expectations, if not exceed them, just as they have been for a few years now. Companies are still spending big on their GPUs. Wall Street's still very bullish, still selling a lot of H100s. They've already got their next generation Blackwell chips lined up. Plenty more runway ahead of them. And there's a look at the price action in Nvidia holding this support box from its last earnings gap up. Analysts expecting 64 cents per share later this month. Current market cap 2.68 trillion. It's fallen below Apple and Microsoft after it briefly overtook them a bit over a month ago. And you see all those charts of America's stock market compared to the rest of the world, and you think surely they've got to converge. And whilst that may happen, I don't expect any major convergence. In fact, American exceptionalism may not be declining, it may actually be accelerating. And one of the best visualizations of that is just looking at the number of data centers in the United States versus the rest of the world. 5,381. Second highest, Germany, 521. United Kingdom, 514. China, 449. Canada, 336. In fact, America has more data centers than the rest of the world combined. That's more computing power. That's more capacity to do a lot of things. And so America is head and shoulders above the world when it comes to AI and compute and processing power out there. That's even starting to show up in a chart of electricity consumption, with American tech companies now starting to overtake entire countries with the amount of electricity they consume. And that's thanks to those data centers. AI uses a huge amount of electricity. We've now got Google and Microsoft using more power than Jordan, Iceland, Ghana, Puerto Rico, and Croatia. Meta and Apple on the rise as well. However, AI, mega cap tech earnings, and the jobs market will have to take a bit of a back seat this week. Up front and center is inflation. Starting off, producer prices index tomorrow. Expected to have risen 0.2% in July compared to 0.4% in June. That would give us a good year over year of 2.7%, down from 3% in the 12 months through June. Then on Wednesday, we'll get the big one, CPI. Just looking looking at Wall Street bank forecasts, they're expecting month over month to be 0.2%, year over year 3%. And if that comes in as expected, along with Goldman Sachs, that are still tracking Q2 GDP growth at 2.5%, and they expect Q3 to come in at 2.6%, with the trade deficit narrowing. And if we get continued signs of disinflation, well, we've still got financial stress and condition indices relatively loose, then it may just be the green light for J-Pow to go ahead and trim the Fed funds rate by 25 basis points, as I'd still give about a 70% chance of it happening. I'd say there might even be more chance he stays on pause than cuts 50 basis points. And just looking at the 2-year yield, whilst there has been a lot of volatility of late, real sharp repricing, pretty much a tantrum by the bond market, I'll be paying attention to the price action in this after we get PPI and CPI this week, as we could get a bit of repricing in the Fed fund futures as well. However, what could really dominate the headlines and markets this week is what's going on in the Middle East. We were expecting this last week, looking like Iran may be getting cold feet. However, maybe they were just gearing up for something even bigger than what was expected, and that could very well be the case. And this could spook markets further, give us another spike in VIX, another pullback in stocks, and gold and oil may be the only places to hide out. Israel military is on high alert. US is sending more and more assets into the region, potentially gearing up for a big showdown, and possibly an offensive mission against Iran as well. If they cause significant damage on Israel, the West has promised a response to Iran. And so Iran looks to be potentially rolling the dice here. They have a history of biting back. Like I said, think of themselves as the top dogs of the Middle East. However, they've never really had a taste of a good Western response to these continued provocations from them. So it appears Iran is building a similar posture to that of the prior attack they did in April in the western part of their country, getting a lot of missiles and other assets ready. The key things to watch for here is A, can they inflict any significant damage on Israel? Will they take any lives? Will they damage any key assets or infrastructure in Israel? And then if so, how big a response will Israel and the West be towards Iran? Or maybe they don't even need to inflict any damage on Israel. Maybe Israel's had enough and trying to give measured responses back to Iran and just take out their military leaders. As they've already proven they can do, they can easily strike within Iranian territory. They may just go ahead and send a couple of hundred missiles back themselves and let Iran deal with that. Either way, it's spooking commodity markets. Oil trading up, that'll be another key leading indicator to watch this week to see how worried markets are about what's happening over there. Also got precious metals turning higher, with gold breaking out to new record highs. And this is just after we heard a week and a half ago that gold demand just hit a record high in the second quarter. That is the amount of actual buying in the market. And that's thanks to central banks, who ever since the outbreak of the Ukraine war started accumulating gold like crazy. And that's the BRICS nations. They saw US sanctions on Russia, locking up Russian assets outside of the country, and they're looking to hedge their bets, get out of the dollar and get their reserves into gold, where the US government doesn't have leverage over them. And that's a trend that's unlikely to change anytime soon either. And so coupled with the fact that we've got an inverted bond yield curve, that's the difference between the 10-year and the 2-year treasury bond yields, screaming back to uninverted territory, which quite often can mean a recession 6 to 12 months later, coupled with elevated geopolitics, not to mention the resurgence in inflation as well. We can see that in container ships still racing up this year, and the potential for unemployment to keep climbing as well. Just looking back in history at previous recessions, what you'll see with unemployment, and this happens a lot in financial markets, trends can start gradually, then happen all of a sudden, similar to how a wave builds in the ocean really slowly, hits a crescendo and then falls over. The same thing can happen in markets. So there is the real potential for a recession, I would say, starting in Q1 or Q2 next year. And so what's a way to position for that or potentially hedge that risk? Well, yeah, treasury bonds can help. Interest rates being cut, that's a strong tailwind. And who knows, wouldn't it be surprised if we actually got a bit of deflation with a recession as well? Prices started contracting. That's good for treasury bonds. They'll protect you against deflation, because you're locking in your money at a certain period of time and you'll get back the same principal in the future. However, treasury bonds aren't good for inflation. That is, if we do get a resurgence in inflation, what's good for both inflation and deflation is gold. And so just looking at the yield curve here in the blue line, if I just overlay this chart with the spread between gold futures and S&P 500 futures in the orange line, you'll see there is quite a bit of correlation. That is, when the orange line's going up, gold's outperforming stocks. When the orange line's going down, gold's underperforming stocks. And if I just go out to a 2-week chart, just to smooth this out a little bit, you can see that correlation between the spread in gold and stocks and the yield curve. So just going back in history, looking at the data we've got here, back in late 05, going into 2006, 2007, the bond yield curve was inverted. It went uninverted, and then gold started outperforming stocks just as the yield curve was climbing back as well. That went on for a number of years. Going back again in the late 90s, bond yield curve went inverted in 2000, went uninverted, and look what also followed it. Gold outperformed stocks for quite a few years going ahead as well. So here we are now with the inverted bond yield curve. The expectation is that it's going to go uninverted, and we could very well be in a recession, like I said, Q1, Q2 next year. Looking back in history, if that were the case, gold could significantly outperform stocks. The other good thing is, if we happen to get a resurgence in inflation, which again, most people are not expecting, just looking at the chart here of inflation in the States year over year. There's that first wave in the early mid-1970s, then it rolled over. Fed thought we were good, started cutting rates again, caused a second and larger, higher wave in inflation going into the late 70s, early 80s. And if I just overlay this chart with gold, followed a very similar path. That resurgence of inflation in the late 70s going into the early 80s saw a massive bull market in gold. In fact, inflation adjusted, we still haven't taken out that high from back in 1979. So the point is, with all this macro backdrop, gold could be a good place to be in the coming years. It's why I have exposure in it, and I'm likely to keep adding exposure to it as well. And just looking at a recent survey of CEOs and the things they're really worried about, here in the blue bar is their most recent reading, in the orange from a year ago. The number one thing they're most worried about is cyber attacks, and that's a strong tailwind for cybersecurity stocks. Next on the list, geopolitical instability. They're worried about war, legal and regulatory uncertainty, AI and new technology, financial and economic risks, coming in at number 5. So CEOs are not really worried about a recession right here. In fact, they're way more worried about a cybersecurity attack on their company. And so that pretty much wraps it up, guys, to get you all prepped for this week. A few key events the market's hinging on this week. PPI tomorrow, CPI Wednesday, a couple of key earnings, retail sales Thursday, consumer sentiment Friday, then probably the big one, Iran. How big are they going to go on Israel? How much damage can they inflict? What will be Israel's and the West's response? And potentially from that, what will Russia and China's response be to Israel and the West? And how much will they go in there and try and backstop Iran? And by the end of the week, we could be in a full-scale war by Iran versus Israel. Hopefully not, but the ball's really in the Iranians' court. Israel took out a few of their military commanders. Iran could be about to send 400 or 500 missiles back in response. And like I said, the Israel and the West may just have had enough of it and want to put Iran in their place. I'll be paying attention to it, along with these other key economic developments, and of course, as always, the price action that we get in markets. Thanks very much for sticking with Click Capital, and I'll keep you updated all throughout the week. Cheers.